Hi. Today obviously the union budget was announced, earlier today, and I'll be sharing a quick take, from Morningstar's end in terms of, how this budget could impact the common man and, the investors as such. So overall, we think it was a balanced budget with focus on both the social sector as well as, measures to boost economic growth, which is very important. If you look at the budget, it was categorized into they categorized the various measures into 7 key areas, right? And I'll just briefly touch upon each of them. The first is inclusive development, right, which included measures for agriculture such as building digital public infrastructure, creating an agri accelerator fund for agri startups, making India a global hub for millets and so on and so forth. The idea here is obviously to boost the agriculture sector, which still employs a sizable portion of the population, and also make obviously India more self-dependent when it comes to sort of agri commodities as such. The second area was reaching the last mile, right? And here the focus is on has been on or was on health and education for the underprivileged. Some of the measures that were announced included setting up of about 150 odd new nursing colleges, creating a national digital library for children and adolescents, training of teachers and so on and so forth. Again, some of these things are very critical for improving the general wellness of the population, the underprivileged section of the society, and creating more employment opportunities. Another very important area of focus for the budget was infrastructure and investment. And out here, as has been the trend over the last few years, the government pushed up the capital investment outlay by about 33 odd percent versus last year to about 10 lakh crores. And some of the other measures include continuation of the 50-year interest-free loan to states to incentivize infra investment by the state, by the states as such. Then they also announced the highest ever capital outlay for railways, which is about 2.4 lakh crores or so. The idea again out here is to create a multiplier effect. As we know, capital expenditure, particularly from the government, can create that effect of encouraging private sector capex and employment as such. So again, that's a very important area of focus to try and sort of boost economic growth over the longer term. Another area of focus was sort of, which they refer to as unleashing the potential, essentially focusing on providing more digital kind of services. We know some of the digital services such as Jan Dhan, Aadhaar, and so on, UPI have been very successful. So now the government is talking of focusing on setting up things like about 100 odd labs for 5G services, which are in the process of being rolled out again to tap employment potential and sort of opportunities as such. Things like setting up of entity digilockers for use by business enterprises and charitable trusts. Again, the general digital loggers have been quite sort of successful, for the general public. So they are expanding that to business enterprises and so on. Another area of focus has been, or was also and continues to be, is focusing on green growth, right? And here they're talking of focusing on natural organic farming, promotion of battery energy storage systems, things like coastal shipping for energy efficient transportation and so on. So again, clearly I think this is aligned to some of the longer term missions and goals that the government has set up to try and move towards more sort of sustainable kind of growth for the economy as a whole. The next is youth power. Again, skilling of youth, particularly in the digital kind of space, setting up sort of centers for training on artificial intelligence and coding and so on, essentially making the youth more technologically sort of increasing their capabilities from a tech perspective. Also focus on tourism as such to try and boost both inbound and domestic sort of tourism as such. And finally, the financial sector, again, a few things, sort of, few additional benefits for senior citizens. One key area was the maximum deposit limit for, senior citizen savings scheme was enhanced from 15 lakhs to 30 lakhs, which is a big boost for senior citizens as such. The deposit limit for the monthly income scheme was also enhanced from about 4.5 lakh to 9 lakh for single accounts and from 9 lakh to 15 lakh for joint accounts. Again, giving some sort of a boost for savings for senior citizens as such. Obviously, an area of interest for most of us would also be the direct tax proposals. There was a lot of, as every year, a lot of people were looking forward to, this section of the budget. And the focus clearly within this space was on the new tax regime, which hasn't been very successful since it was launched about 2 to 3 years ago. Not too many people have moved to that, but they're trying to get more and more people to adapt this tax regime. So effectively, they've added some benefits out here. For instance, the basic exemption limit has been increased to 7 lakhs, from 5 lakhs earlier. The number of tax slabs has been rationalized from 6 to 5 as such, and a few other measures to try and get more people, taxpayers to move from the old regime to the new regime. And clearly that seems to be the primary focus when it comes to the tax regime as such. In fact, no changes have been made to provisions within the old tax regime. Essentially, people were expecting that certain exemptions, say for housing loan interest and so on and so forth, those would be enhanced, but nothing of that sort has been done. So clearly it appears that the government wants more and more people to try and adopt the new tax regime versus the old sort of tax regime. So even in fact going ahead, we think that the government may not really try and increase the benefits under the old tax regime, and they would probably try and continue focusing on the new tax regime. In fact, now the new tax regime has also become the default option for taxpayers. So although they have a choice to adopt or to opt for the old tax regime as well, but the new tax regime is the default option as such. And like I said, it doesn't seem likely that they will come up with any additional benefits for the old tax regime per se. At least from our point of view, the way we think of this is that the old tax regime encouraged savings and investments, right? It gave benefits for investments into ELSS and insurance and so on. But the new tax regime has removed most of these exemptions, and it's now up to the taxpayer on how they use their money. So we're not sure if that's the best way to approach. If you want to encourage people to save more and into financial instruments, maybe that is one of the benefits of the old tax regime, as such. And another area which markets were really looking up to was changes in the capital tax norms. For instance, things like bringing parity in terms of how short-term and long-term periods are defined for various instruments such as equity, debt mutual funds, and so on. That didn't come through. In a way, markets viewed it as positive because at least equity markets were fearing that the definition of long-term might be increased from 1 year to 2 years, so which hasn't happened. And that in a way was sort of taken positively by markets. And finally, looking at the fiscal side of things in terms of how the numbers add up, the fiscal deficit is estimated to be about 5.9% of GDP, which is lower than the revised estimates for last year, which was at about 6.4%. And the government has sort of reiterated that they would continue on the path of fiscal consolidation, and they'll try and reach, they aim to reach a fiscal deficit of below 4.5% by about financial year 2025-26. So a fairly steady decline over that period as such. And thinking of it from a fixed income or a bond market perspective, the market borrowings that the government has sort of put out in the budget were broadly in line with expectations, so which is a positive for bond markets as such. Now, what does all of this mean from an investor's perspective, and what are our views across different asset classes, right? So we think one is, of course, the budget is a long-term positive for markets, given the focus on capex, infrastructure development on the one hand, and on the other hand, creating jobs and building skill sets for the underprivileged. So I think it's a fairly good balance that the government has managed to sort of strike in this budget. Looking at it from an equity market perspective, we think domestic equity markets seem to be attractively valued. I mean, in the sense that they seem to be a little bit expensive, and they're pricing in some of these positive factors as such. If you look at over the last couple of years, Indian markets have done reasonably well as compared to international markets, and therefore we think at this point valuations look a little bit rich as compared to historical averages. On the other hand, we think international markets which have underperformed over the past couple of years look attractive from a valuation standpoint. Regions such as Europe or other emerging markets such as China, we think look fairly attractive from a 3 to 5 year plus kind of a horizon. So that's on the equity side. Given the rise in interest rates over the past 12 to 15 months, and also the well-defined fiscal consolidation path, which was sort of reiterated in the budget, in our view, this makes fixed income or debt investing look quite attractive. We think from a risk and reward perspective, at least over the near term, so to say, relative to Indian equities, fixed income looks reasonably attractive as such. So that's in summary of our views, on the measures that were announced in the budget today, and our views on various asset classes and the impact of some of these measures that were announced. So with that, thanks for watching this video today, and hope you find it useful.